Chapter 5 gets at the concept of different system designs as we take a look at how we're going to cost products out. Managers need to assign costs to products in order to facilitate external reporting, but even more importantly, so they can estimate what's going on within their business. Costs are assigned in order to figure out what the right pricing model might look like for products or services that are offered. The chapter uses terms like absorption costing or full absorption costing, and it starts by taking a look at two major methods of costing out products or services. Those are concepts that were introduced earlier in the year, so it might be worth a quick review of Chapter 2 if you're not sure what they're getting at. But in reality, all they're saying, full absorption costing, is just simply saying that every cost associated with producing a product is assigned back to that product or service, so managers can make sure that they've accounted for every cost. I feel like I'm overusing that word, but that's really what it is. So they can account for every expense associated with bringing a product to market. Two methods are used and reviewed within the chapter. The first one is just a quick review. It's process costing. Basically, if you have a single product that is produced the same way time over time over time over time, you're following a process, and the costing methodology is probably going to be a process costing methodology. Think of things like the production of beer or paper. The production process doesn't vary from time to time to time, and likely the product is going to go from a mixing department to a bottling or cutting department to a shipping department, etc. So costs are accumulated on a product by product basis. Contrast that to job order, where the product or services that are delivered vary a great deal from job to job to job. So the construction of a house, a construction company, or the development of software are some examples. Your book uses a law firm as an example. So people go see a lawyer and they may first time in seek a real estate transaction and then go back for some estate planning. Maybe they come in with a couple of friends and talk about how to set up a new business, and maybe they need partnership agreements. The types of documents and services that are provided by that same group of lawyers could vary greatly, so you'd want to be able to track items on a job by job by job basis. Slide just gives you a summary of how you might want to think about it. Basically what you're getting at is the fact that there are three primary costs that you've got to be concerned with. As we've talked about in the past, direct materials and direct labor go directly into costing out a product. They're very easy to trace directly to the product. Manufacturing overhead, on the other hand, is difficult to trace. It includes anything that is not considered direct material or direct labor, and manufacturing overhead is allocated based on some assigned cost factor over on the product. So for example, you might have costs like factory rent or supervisor salary or electricity or maintenance cost, and it's going to be applied based on a predetermined overhead rate. The predetermined overhead rate, as is outlined in the chapter, is going to be a simple calculation of the total manufacturing overhead costs that are estimated at the beginning of the period. So manufacturing overhead cost, again, rent, salaries, maintenance, electricity. What's your budget? What's your estimated budget for those items? And you're going to divide it by the number of units that you estimate that you're going to produce in that coming period of time. So you're coming up with an estimated overhead rate that you're then going to apply on a product by product basis to determine what your overhead rate allocation to an individual product is going to be. So as a quick kind of what did I just say? You're applying manufacturing overhead, which cannot be directly attributable to a product or services. You're applying it down to a unit level in order to keep your accounting at a unit level. You're going to first estimate the level of production for a period of time. You're going to estimate the total amount of the allocation base. So what does that mean? How many direct labor hours do I think I'm going to use this year? how many machine hours do I think I'm going to use this year? So it's the total amount of that base, and you're going to estimate what your overhead is going to be. So salaries, rent, you're going to divide those two out, and you're going to have an estimated overhead rate that you're going to apply then to actual activity. So it's your overhead rate estimated times your actual activity gives you a calculation of the overhead that's been applied to that product or service for the year. And if you have multiple products or services, your allocation methodology could be different between them depending upon kind of what makes sense overall. So for example, if you have a product that you're producing that's highly labor intensive, you're probably not going to use machine hours as your allocation base. You're probably going to use labor hours as your allocation base. Just something to keep in mind overall. The system then gets into a discussion of how do costs make their way to a product, and that's what this job order costing section of the chapter is all about. If we look at direct materials first, we're going to have direct materials that are going to go directly into a job costing sheet. Those direct materials were requested off of a materials requisition sheet. Anything that is not a direct material is going to go to a manufacturing overhead account where we're going to take a predetermined overhead rate, we're going to multiply it by our actual units of production, and we're going to calculate an estimate that's going to make its way up to the job costing sheet. If you look at direct labor, it's exactly the same thing. Instead of a requisition sheet, a materials requisition sheet, you have an employee time card. Their direct labors go into the costing sheet. Indirect labor salaries for managers, for example, are going to an overhead account and they're being allocated, and then they're making their way into the costing sheet as well. So you have your indirect labor, your indirect materials, your overheads being applied, and as we said, that's matching up with direct materials and direct labor that are on your costing sheet. Because your indirect materials and indirect labor have been based on an estimate, the estimate needs to be trued up at the end of the year. So you're going to find that you've either under or over applied your overhead. And why is that? It's likely because your units of production are different than what you thought they were going to be. If you have overhead that has been under applied or overhead that has been overcharged, over applied, you're going to process an adjustment through your cost of goods sold. And in your book on page 180, there's a discussion that starts on how you're going to adjust your income statement through your cost of goods sold. Basically, under applied overhead is added to your cost of goods sold, and over applied overhead is subtracted in order to get your final cost of goods sold. And there's two methods that you can use to allocate your under or over applied. It's the direct method or the indirect method. Both of those are described really well starting on page 180, and you should take the time to review those in your chapter. We're going to walk through a couple of videos in some separate or a couple examples in some separate videos. I encourage you to make sure you read the chapter, focus heavily on the allocation methodology that's being talked about for manufacturing overhead, pay attention to what happens with over and under applied overhead, and ask some questions if you have them. You can reach me by email, and if you need one-on-one discussion help, I can help you over the weekend. But review the videos that will show some examples to maybe round out your understanding after you've reviewed the chapter and this general overview.